I'm Mohammed Rashid, and I'll be taking you through the basics of banking, what it means, how it works, and why it's important for all of us. Banks are at the heart of every modern economy. Their primary role is to channel funds efficiently, taking money from those who have a surplus, like savers, and providing it to those who need funds, like borrowers. They manage risk, keep payment systems secure, and turn savings into productive investments that help businesses grow and create jobs. Without banks, financial markets would be incomplete, inefficient, and far more costly to operate. Based on this applied question exam point of view, applied/scenario questions. If people stopped depositing money in banks, how would it affect lending? How could a banking crisis affect an entire country's economy? What are some examples of non-financial factors that also affect banks' performance? Banks act as financial intermediaries, moving money from savers to borrowers. Direct lending is costly and risky, but banks provide trust and safety. They offer liquidity. You can withdraw deposits anytime, while lending those funds long-term. By transforming maturities and diversifying risk, banks keep the financial system efficient and stable. And the short questions. Why is direct lending costly and risky? What is liquidity in banking? What is maturity transformation? Banks play several key roles in the economy. They create credit by providing loans, which increases the money supply. They operate safe and reliable payment systems, like checks, transfers, and cards, to keep transactions flowing. They mobilize savings by pooling small deposits into large investment funds. Banks also offer wealth management, such as investment, retirement, and risk advisory services. Finally, they help maintain economic stability by transmitting monetary policy and supporting overall growth. Possible questions. What role do banks play in payment systems? How do banks mobilize savings? What kinds of wealth management services do banks provide? How do banks contribute to economic stability and growth? Information asymmetry. Borrowers and lenders face information asymmetry. Lenders usually don't know enough about borrowers to judge risk. Banks specialize in collecting, analyzing, and verifying credit information. They monitor and screen borrowers to reduce bad loans and cut the costs that individual lenders would otherwise face. Possible questions. How do banks reduce the risks caused by information asymmetry? Why is borrower screening important for banks? How do banks help reduce the cost of lending for individuals? A small business owner needs a loan, but individual savers don't trust him. Which banking theory explains how a bank can solve this problem? During a financial crisis, many depositors withdraw their money at once. Which theory is most relevant to understanding how banks handle such liquidity pressure? Imagine a saver has to check every borrower's repayment capacity individually. Which banking concept removes this burden from the saver? A bank pools thousands of small deposits to fund a large infrastructure project. Which theory explains how this reduces the total cost of lending? A bank spreads loans across multiple industries instead of lending to just one company. Which theory is at work here, and why does it reduce risk? If banks stop assessing creditworthiness carefully, what impact would that have on defaults and trust in the financial system? The key principle in investing is the balance between risk and reward. Higher potential returns usually come with higher risk. Diversification, or spreading investments across different asset classes, helps reduce that risk. Long-term strategies build wealth gradually through compounding returns. Having a basic understanding of how different investments work lets you make better decisions and align your investments with your financial goals. Applied questions 2. If an investor puts all their money into one company and that company fails, what principle of investing was ignored? How does compounding support long-term wealth building even with moderate returns? Banks help the economy work better by allocating capital efficiently, directing funds to productive sectors. They reduce the cost of borrowing and lending, share risk among many participants, and create liquidity so depositors can access money anytime. By turning savings into investments, banks drive economic growth and boost GDP. Applied questions 2. If banks stopped providing liquidity, what immediate problems might depositors and businesses face? How does directing funds to productive sectors help increase a country's GDP?